So want to become good at this, want to spend an hour or two a day, want to target, by the way, please write this down. My minimum target for you is about 100 points a week. So 100 points a week is where we start beginners off as the initial trading target. So if you're hitting 100 points a week and you're trading at about $10 a point, you're making 1,000 a week. It's not massive money to start with, but I still consider $1,000 a week is still pretty good money. Would you guys agree with that, yes or no? And then from there we build. I run trading floors in Johannesburg, in London, in Sydney, in the US. I can tell you now, in current market conditions, which for all other reasons are hectic, for currency trading, they are incredible, absolutely incredible. We have traders on our trading floors now with their trading targets move from 400 to 1,200 pips in these market conditions. That means you've got 24 and 25-year-old guys who started trading 2 years ago looking to make between 10 and 25,000 pounds a week. They wouldn't be doing that in any other kind of job. And all they're doing is executing on the very same trading strategies I took from the trading floors I used to work on when I was a similar age. So let's jump into why do we trade foreign exchange. First of all, let me tell you this. Currency trading is what millionaire traders do. And the reason for that is it's the most liquid market in the world. This market is $4 trillion US a day. What does that mean to you? Well, I'll tell you what it means to you. If you're somebody who wants to get rich in an asset class, you want to pick an asset class that does not get more expensive the bigger you get. If you were trading the stock market and you got bigger and bigger and your trades started getting bigger and bigger, would it cost you more to trade, yes or no? And the answer to that question is yes, of course it would, because you'd have to pay more to get more stock, because there's stock at different price levels. When you're trading the currency market, $4 trillion, you can put €500 million in the market and take it out in a split second. It's going to cost you the same as if you put $10,000 in the market and took $10,000 out. So this is why traders of size use this market. Now let me tell you something else. Please write this down. Currency trading is low-risk trading for one very important reason. Currency trading is low-risk trading for one important reason. Liquidity is precision. Liquidity is precision. In other words, the more liquid a marketplace that you're in, the more likely it's going to do the thing that it should do. What does that mean? Well, stock markets, can they be manipulated, yes or no? Easily. Stock markets and illiquid stocks can easily be manipulated by a few small people. 3 or 4 people who've got deep pockets can manipulate a stock market. A currency market, it's $4 trillion, cannot be as equally manipulated, and therefore it makes it safer for you to trade in that environment. Now, with $1,000, you can control over $100,000, so of course you can make your money work very hard. And if you consider the New York Stock Exchange is a swimming pool, then by some kind of contrast, the currency markets is the equivalent of 9 Atlantic Oceans, so it's much, much bigger. It trades 24 hours a day, which means you can trade whenever you want. Some of you will want to trade in the morning for an hour, some will want to trade in the afternoon, some will want to trade in the evening. It's open all day long, 5 hours a day. The problem with the stock market is it closes during the day. And if a market closes during the day, that creates risk. Think of it like this. If I can just jump to the video screen, to the pad over here, what happens when you're holding stocks? Here's your biggest problem if you trade stocks. Here it's Monday, here's Tuesday, here's Wednesday, here's Thursday, and here's Friday. Now, here goes the stock. You buy the stock here, and by Tuesday it moves up to here. Something happens overnight on Wednesday. What happens to a stock market every evening? It does what? It closes. Well, if the stock market closes on Tuesday night and some profits announcement comes out, and you decided you wanted to get in here, whenever you place a trade in any market, there are 3 things that you've got to place. Let's capture what they are. The first thing is your entry. So we call this your entry price. This is where you get in. Let's say this is your entry price and it's here. That's the first thing you do. The second thing you want to place is something we call a stop loss. And this says, this is where I get out if things go wrong, which of course they can. And the third thing we might have is a target price. This is the profit we're looking to make. And let's say it's up here somewhere. Well, everything's going well. You bought here on Monday. It's looking good. By Tuesday, it's up a little bit. And then something happens on Wednesday, early in the morning, a big profits announcement, or something happens abroad, and the market's closed. But when the market opens up, the market is now down here on Wednesday morning. The market has jumped from here all the way down to here. Scurriedly, you jump onto the phone, you phone your broker, and you say, what's going on? And the broker says, oh, I don't know, there's something happened overnight, the stock's trading a lot lower. And you say, yeah, but my stop loss was in here at 94.50. I want to get out at 94.50. I got in at 95. I want out at 94.50. And the broker says, yeah, I'm afraid the stock right now is down here at 9100. And you say, yeah, I understand that it's at 9100, but I put my stop loss in at 94.50. I want to come out at 94.50. I came out at 94.50, didn't I? What does the stockbroker say? No. So I said, no, it's at 9100 now, so what do you want to do? He said, well, I wanted to come out at 94.50 where I said I wanted to come out. He said, yeah, I know, but stuff happened overnight. It's now at 9100. What do you want to do? And you say, I goes, well, actually, so now it's moved down to 90.99. What do you want to do now? And of course, you say, get me out, and you take the loss. And this happens when you're a stock trader all the time. It's called gapping. Gapping. And if you've ever traded stocks before, particularly in Australia, because it's more of an illiquid market here than anywhere else, it's a nightmare. This can be a big nightmare. This doesn't happen so much in the currency markets because the currency markets are always open overnight. If something was to happen overnight, it would trade through where your stop loss was and take you out so you retain your profit. Does that make sense, everybody? Yes or no? So that's one of the reasons we use currency. If we can jump back to the PowerPoint, that's one of the reasons we use currency as a tool because it means there's less risk out there for us. Now, let's look at some essential things here. Most of you are already currency traders. How many people here have been on holiday before? Okay, good. So you know that, for example, let's say you're in England, which is obviously where I'm from, and you exchange £100 and you get 155 US dollars. You go off on your big US tour, and when you come back, you realize that you receive 110 pounds for every 155 US dollars you exchange. You're like, hold on a sec, I've made 10 pounds. How did that happen? I was on holiday, I came back, and I'd made 10 pounds. Well, unbeknownst to you, when you were on holiday, of course, let's just click that one on. You left on the 1st, Wednesday, and you didn't intend on coming back till the 24th. And as far as you're concerned, you were on holiday for a few weeks. But what was happening in the background, of course, is that the currency markets, the British pound against the US dollar, was exactly doing that. It was falling. The British pound was falling against the US dollar. So essentially, you were earning more money, unbeknownst to you. Well, then imagine every £1,000, by the same token, you could convert into 100 or 1,100 pounds. You'd make a profit of 100 pounds. Well, imagine every £10,000 you could convert into 11,000 pounds. You'd make a profit of 1,000 pounds. And this is specifically what foreign exchange, Forex trade, this is what we do. It's purely the process of buying and selling money. But instead of waiting sort of 20 or 24 days to get the profit, we do it within minutes, or we do it within hours. And in this market, under these market conditions, with the leverage and the way we can manage the risk, the income can be fantastic. Now, what else drives the market? Well, of course, fear and greed drives the market. I'm just going to play you a video now, and this kind of tells you what's happening. And then I'm going to show you a strategy right here now in this seminar that if you're fast with a pen and paper, you can use straight away next week, and it will make you between 100 and 180 points a week. That's $1,000 to $1,800 a week. Would you guys be interested in learning that? Yes or no? Yeah, okay, cool. Now, you're going to be fast with the pens because I'm going to give you all the rules. Fear in Forex trading is your greatest friend. Fear is your greatest friend. All the money in the currency markets is made out of fear. That's where the big cash is. I'm going to show you that strategy I promised you. Before I do, let me just show you this chart here. This is what a bar chart looks like. And then I'm going to get busy on the whiteboard here in a second and show you exactly what we do to make ourselves what we call a few quid every week. So on the left-hand side, you're seeing a green bar. And notice there are 4 elements to the bar. There's a high and the low. And then the left-hand handle is where the market opens, and the right-hand handle is where it closes. Can everybody see that, folks? Yes or no? Yeah. And the left-hand one is the buyer bar, and we call that a buyer bar or an up bar. And notice you can see on the left-hand side there, it could be one of many different time frames. That bar could be measuring hours or minutes or days or weeks or whatever you like. But the point is, the bar, the 4 elements of it, tells us what's happened in that session, in that period of time. So the green bar tells us that whatever happened there were really more buyers there than there were sellers. Conversely, the one to the right is the seller bar, and you can see it opened high, went up a bit, then it fell, and it stayed down. Does everybody see the fact that it stayed down? Because the right-handed handle is where it closed, and that stayed low. Everybody got basic concepts of what a bar looks like, folks? Yes or no? Now, there's something that happens. I'm just going to jump on the notepad here. There's something that happens about 3 times a week in the currency markets. And every time it happens, you can make yourself about 60 points every time it happens. And it happens about 3 times. So there's about 180 points to be made. Would you like to know how it's done? About 4 people want to know. What about the rest of you guys? You guys up for it, yes or no? Okay, so let's have a look. Pens at the ready. We are looking at 3 currency pairs. Ready? They are the euro against the US dollar. That's one. We're looking at the British pound against the US dollar. That's the second one. Or we're looking at the dollar against the Swiss franc. They're the 3 currency pairs that this works with. Now, we're looking at this at about between 5 o'clock in the morning, Greenwich Mean Time, so this is London, between 5 o'clock in the morning and about 9 o'clock in the morning. So that block of 4 hours from 5 in the morning till about 9, this is where all the money's made. And what we look for is, let's say, for example, this little bar here is the 5 o'clock bar. That's the 5 a.m. Is the bar going up or is the bar going down? It's going up, isn't it? It opens here, and it goes up, and it closes here. That's 5 o'clock. Then let's say 6 o'clock looks pretty much like this. This is the 6 a.m. bar, does that. Let's say 7 does that, and that's going up a bit too. So, and let's say the currency we're looking at is the euro here against the US dollar, the euro against the US dollar. Now, one would consider it's early morning, it's the European session, the market's up a little bit, and 7 o'clock it's gone up, and it's come back down. Now, how many people here would consider the market is just going up? That's what's happening. Quick show of hands. How many people here think the market's going down? 1 or 2 people. How many people here don't know? Good, okay. So this is what we're looking for. You just watched a video. Did you see the part of the video with the Americano in the 10-gallon hat? And he was saying that fear overrides all rational thinking. Do you guys remember that part? Write this down. Fear overrides all rational thinking. This is an amazing thing if you want to make money. Because people in their million loads do things irrationally practically every single day. And if you know what they're doing, you can monetize it very quickly. So we look for this. What's happening here, if I could just zoom on that bit there, that's perfect. Now this means the market opened here, it went up, which to all intents and purposes would mean the market is rallying, it's moving upwards. But something else happened. It then came all the way back. Do you remember in the video when the herd was moving in one direction, the herd changed direction, yes or no? This is the changing of direction intra-bar. Each of these bars is 1 hour long. It's 5 o'clock, 6 o'clock, 7 o'clock. This goes up and then it falls. And now it's here and it's closed here. It's still an up bar because it's higher than where it opened, so it still makes it an up bar. And to the uninitiated, it looks like things are still moving up. This is not the case. Things are not moving up now. Here is fear in the bar. It went up and it fell all the way down, leaving a long tail on the bar. The next thing that happens for us is we draw a line underneath the bottom of that bar. And then when the 8 o'clock bar opens, we expect this to happen. And if this happens, remember I said to you we do 3 things, 3 orders. What did we say? The first one was called a what? Entry. Do you remember that? What was the second one called? Stop loss. Brilliant. So we had the entry, so we would enter here, entry. We're going to put a stop loss up here. Stop loss is up here. And then we are going to sell this market. And we are going to expect it to do this. And we're going to sell it, and we're going to take 60 points. 60 points. And when we get to 60 points, we are going to take the trade off the table. Now, when this happens in the currency markets, don't forget the currency markets run hundreds of points every day. And generally speaking, and from trading this position live, this normally runs 100 to maybe 150 points. Do we look for the 100 or the 150 points, folks? Yes or no? Absolutely not. We go for the 60. We take the quick 60 points. We sell the market here, which means we short it, which means we are betting on them, if you like, we're betting on the market falling. And if it breaks through here, there's a very, very high chance it will fall quite a long way, and we'll take the 60 points off the table. We limit our risk to here. This is where we place our stop loss, and we'll do this between 3 and 4 times a week. And that, in short order, is how you make 180 points a week. You guys up for that, yes or no? Useful strategy? Please write that down. Now, there's a couple of other things we need to know to make that happen, so I'm going to go through those as we get into the session here. But that is called the high test euro. It happens on the British pound against the US dollar, it happens on the euro against the US dollar, and it happens on the dollar against the Swiss franc. And the reason that happens is there's offset balancing happening between those major currencies that happens in the early European session to kind of ratify what happened the day before. And so as traders, we do not sit there for 8 hours a day, scratching our head, waiting for an opportunity to present themselves. I personally don't believe that's the way to make money. There's a few things some of the best proprietary traders in the world do, and that is they look for certain signals, and they know, most importantly, when those signals are going to occur. And when those signals do occur, they simply put those trades on and take the money, and then they walk away. Does that make sense? I personally believe anyone in this room could do this at any time. I think the key to making money trading is to make sure that you marry up your time frame availability with what works well then. Does that make sense? When I have traders, when people come and train with us, whether it's in Australia here or South Africa or in London, wherever you are in the world, we train you and then we sit with you with a trader and we go, okay, Bob, when are you free? And Bob goes, what? Well, how much money do you want to make, Bob? Bob says, well, I want to make $10,000 a month. I go, Bob, how much money you got to start with? And we figure, he says, well, I got this amount. Great, when are you free? And he says, well, I can be free whenever. I said, no, Bob. If you can be when you're free whenever, Bob will never be free at the right time. Does that make sense? So we figure out when Bob's free. Bob says, well, I've got to run the kids to school at 7 in the morning, 8 in the morning. That's my job. But after that, I'm available at 4 in the afternoon and 9 o'clock at night. Well, there's something that happens at 4 o'clock in the something that happens at 4:30 in the afternoon every single day. And if Bob's around at that time, would it make sense for Bob to then put that trade on and manage that? Yes or no? It makes no sense for Bob just to pop on there at 10 o'clock in the day when there's nothing really happening and hope he's going to scratch his head and make some money trading. So this is all about knowing what to do and most importantly when to do it. If I could just jump to the next slide. Okay. So for example, the game here is all about pips, collecting points. In the trading world, in the foreign exchange trading world, we look at 4 decimal places. So you look at the British pound against the US dollar, it's 155.70. The real important bit here is the 70. That's the bit we care about. So if you imagine the British pound, we bought it at 155.70. We'd really look to sell it at 155.90, let's say. And if we did that, how many pips have we made? How many? 20, that's right. And if we were trading at $20 a pip, we'd make $400. Good. Now, let me teach you the important bit right now. This is key and critical. So again, get ready with your notes. You now know how to make money trading a little euro position every day. Let me teach you how not to lose the money, because this is important. Traders who are successful say this. Well, actually, let me tell you what losers say first. Losers say, how much money can I make? Please just make a note of that. It might sound like a silly thing for you to write down right now, but just go with me on this for a second. Write down, how much money can I make? When a human being asks their brain a question, does the brain always try and answer the question that's posed to it in some way, yes or no? Yes. And see, when we ask the question, how much money can I make, the brain tries to answer that by saying, well, I can make as much money as I probably put on the trade. And what that ends up happening is that leads to overtrading and gambling. People who make money consistently trading, and a lot of it, ask the following question: how much money can I afford to lose? That's right. So let me show you that as an example. The first rule of trading is to keep the risk to 1%. What percent? 1%. So take a look at the following example we've got going up here, and you'll see this again is the famous British pound against the US dollar. You'll see the British pound is hitting up against a red line we've drawn on the chart there, and that line is called a line of resistance. What's it called a line of? Excellent, resistance. And you'll see the market then falls away. I'll point my laser pen up here if you can all see that. So this is hits there, fails, hits there, fails, hits there, fails. And it'll all fall away. And then you'll notice the market turns around at this point and rallies. And as the market breaks up through this old line of resistance, and it's now above the line of resistance, we've cheekily changed the name from resistance to a line of support. And notice I've changed it and we've made it green. And now the market is trading above that line of support and off it goes. Now, here's what we don't do. We don't ever buy the extension. So watch what's happening here. See the market's rallying and see how the market's broken through this line? Generally, your amateur traders would look to buy the breakout. So they would want to get into this position here. They buy it here. Let me just zoom this in a little bit here. That's a bit better. Good. So your amateur would try and buy it here. Do you see that? They'd say, oh, the British pound is hitting new highs, it's breaking out, let's buy it. The problem with that is what happens immediately after it's broken out, the market does what? It falls. Do you remember earlier on I was talking about that there's a dynamic that happens in the currency markets where as soon as markets break out, they do something, they test. Do you guys remember that concept? Yes or no? Of course, this is what happens in currency trading. It doesn't happen in stock trading, it's different. In currency trading, the major market players, they test the market. So as soon as it breaks out, we don't buy it here at all. We wait for it to come back, test, and then we get into the market. Is everyone clear on that? Yes or no? And so then, let's say we decide we're going to get into it somewhere around here. Notice these long tails. They're the opposites of the ones we saw before. So we're looking for this as an entry. So the first question we have is, okay, well, let's figure out A, where do we get in? Please write this down. This is the anatomy of making a successful trade, the anatomy of making a successful trade. I teach this to traders, hedge fund traders, prop traders, trading floor man, all over the world. Same technique, here it comes. So we enter the trade on the pullback. So write that down. We enter on the pullback. That's where the market's broken through that level and it's then falling or testing or pulling back. And it's right at that point where it's like, is it going to fall or is it going to bounce? Does that make sense? And we're looking for a confirmed signal that says, yeah, it's bouncing. That's because it goes down, it's pulling back up. It comes back down, pulls back up. And when we have a double confirmation on that, that tells us we can take this and we can now buy this. Does that make sense, everybody? Yes or no? Yeah. Now, that's the first step. Step two is we've got to figure out, well, that's all well and good. It still may completely go wrong. Is that true too? So we've got to imagine this thing could go wrong, and if it does, we've got to figure out where the hell we're getting out. And here is where we place the stop loss. Notice where the stop loss is placed. The stop loss goes underneath the line of support. It doesn't go up here. Bad area. It must go underneath here to be protected in case something goes wrong. Does that make sense to everybody? Yes or no? And then all we do is step three, we now measure the distance between where we get in on that pullback and where that stop loss goes. And the distance between those 2 points is called the risk. And the risk here is 50 points. So now we know we're risking 50 points. Please write that down. The risk here is 50 points. We've got to figure out, well, so what? What is that? How do I use that information? Here's how we use it. Whatever is in your trading account, we multiply that by 1%. So if you have $10,000 in your trading account, which is my starting point, we know 1% of 10,000 is 100, which means whatever happens, we cannot afford to lose more than $100 on any trade we place. Does that make sense, everybody? Yes or no? That means if the trading account was now $9,000, how much could we afford to lose? 90. If the trading account moves up to $15,000, how much can we afford to lose? 150. Do you understand? So you dynamically change how much you're willing to risk based on the size of the account at all times. Important credo of successful trading. So we know it's 1%. So the simple math here is we take 1% of the account, which we said was £100 of a $10,000 account, and we then divide it by the risk on the trade, which in this case was 50. And we now know that the trade size is $2. So importantly, the trade we placed here, if we had a $10,000 account, was only $2. That means every point that market moves up, we stand to make $2 per point. Is everybody clear on that? Yes or no? See, this is what we focus on. Professionals focus on not how much I'm going to make. Because if you're making a profit, it will take care of itself. The only bit you need to focus your attention on is what happens if it goes wrong. This is what we call the power of negative thinking, if you like. We manage the game from, if it goes wrong, what do I do? because there's a good chance it could go wrong as well. Does that make sense to everybody? We look at the power of negative thinking. We say, look, my negative expectation is this is going to go wrong. How do I limit my downside? And in doing that, regardless of the fact this trade makes $800, that's not the important part. The important part is whatever happens on this trade, the maximum I'm going to lose here is 100. People think if I bet big, I'm going to win big. That is completely incorrect. If you bet big, you're going to get wiped out. If you lose 50% of your account, you need to make 100% just to get back to where you started. So we always manage the downside risk and we keep it to 1%. Now, there's two other important rules I want to give you, which is when we enter the trade, we don't want to enter the trade when it's noisy. So please write this down. We enter trades when they are quiet and the bars are small. When they're quiet and the bars are small. I'll illustrate that in a second. And when we place the stop loss, if you remember from the example I've shown you, stop losses go underneath levels, and they go in places where the chart is nice and quiet. And so these are the real basic and core principles, but they're critical. So what does that mean? Let's put it all together. Well, imagine, for example, a market looks like this. This is where your amateur gets into the market. Notice. Why? Well, if you look at the bottom here, this is where it's boring and it's quiet and nothing much is happening, so people are uninspired to get in. But all of a sudden, the market starts to move up, and people say, it's up 20 cents. Then they say, it's up 30 cents. We better get in. The reason they're getting in is because they're being driven by two important emotional forces. These are, write these down, excitement, excitement, and social proof. Excitement and social proof. These will drag human beings into trades because they don't like the concept of missing out. Nobody wants to miss out. Nobody wants to miss the boat. Everybody wants to make sure they're there capturing the profit. So what's happening is they're excited and they're getting pulled in. Now what happens? Well, then the market side tracks along. What do you think is going to happen next? It's going to fall, and this is what happens. And of course, the painful exit happens around here. This happens every single day across markets all over the world. Now, let's just think about what's happening here. What if the market is $4 trillion in size? What is causing it to move up? Is it big players or is it little players? It's big players, isn't it? Big players are causing that market to move up. Who is trying to get out of the position here? Where these guys are getting in, who is trying to exit at this point? It's the big guys. The big guys got in down here when it was quiet, and the big guys are trying to get out up here. It's the little guys who have got excited by what the big guys are doing that effectively are trading against them. And when that happens, they lose out. Does that make sense? So let me just recap quickly, because I want to make sure you guys have got some really good notes here. First of all, we said the maximum amount you should risk on a trade percentage. 1, excellent. We said if you enter the trade, the buyers on the chart should be big or small? Small. And we said the stop loss should go in a place on the chart which is noisy or quiet? Quiet. Good. And we also said, when we get into a trade, we're waiting for a pullback, a bounce, rather than getting in on an extension or some excitement. Does that make sense to everybody so far? Yes or no? Are you making some good notes? Is it useful so far? Okay, I'm good. Then the jet lag's worth it. Right. Fair enough. The question I have is, will you actually do this?